I am Brock VandenBerg. I am the president of TaliMar Financial. TaliMar Financial has been a hard money lender, or also known as a private money lender, here in the San Diego market since 2008. And for those that have been with us from the beginning, we've quickly grown from providing trustee investments into a mortgage fund platform. So go ahead and share my screen. And what you all should see is the beginning of the presentation. Now, I will be recording this, so I will provide a link after the event. I'll provide a link to the recording, and then also provide the slides. If you just want to email me, my email is right here if you want to take that, or if you already have my email address, go ahead and request the slides. I'll be more than happy to provide them to you. Before I get started, I just want to put a quick disclaimer together. This presentation is not an offering document. The presentation is provided for informational purposes only. It does not constitute an offer to sell nor a solicitation to an offer to buy any security. Such offers can only be made by the private placement memorandum or related subscription documents. Please be aware that this presentation cannot and does not replace the PPM. Any things that I talk about in this presentation could be forward-looking, including future plans, objectives, assumptions, estimations, projections, and may include a variety of unknown risks and factors. Obviously, there is no assurances that any investor is going to make money in a mortgage fund. In fact, you may lose some or all of your money. So hopefully over this presentation, we can provide some ways to mitigate your risk. But if you're interested in learning more about the mortgage fund, I would be more than happy to talk to you about it directly, or you can obtain a copy of our private placement memorandum and executive summary, which I'll provide a link to you after this event. Now, again, we highly recommend that you speak to your CPA, attorney, or other qualified professional before considering an investment in a mortgage fund. This can be a complicated investment. It is good to get a third-party assessment of the risks of investing in a mortgage fund. So with that, let's go ahead and go over some of the items we're going to talk about today. Now, on the bottom or on the right, depending on what type of platform you're watching us on, you'll have the opportunity to ask questions. I will try to get to those questions at the end of the program. So please just go ahead and enter those questions in, and I'll get to answering those questions at the end. So starting off, I'm going to talk a little about TaliMar Financial. Some of you that are on the webinar today are new names, so you want to get some background on who we are. Some of you have been investing with us for over 10 years, so I just want to say thank you very much for that. We're going to talk about generally what is a mortgage fund. We'll talk about how does a mortgage fund differ than a trustee investment. For those that currently invest in trustees, we'll go over the pros and cons of investing in a mortgage fund or a trustee investment. We'll also talk about the advantages of investing in a mortgage fund, and there are a lot of advantages that I want to cover. We'll also talk about the risks and the headwinds for the mortgage fund industry, with obviously the volatility in the market, especially interest rates rising very rapidly. There are some items that a lot of mortgage fund managers are having to deal with today, and we'll kind of cover that and things that you can look for if you currently invest in a fund, things that you can look for that to make sure that your investment is safe. Then we'll talk about the fund that we launched earlier last year. I'll go into some details about how it's structured. We'll talk about kind of what the loans are in the fund, and then I'll finish off by providing you some insight into our lender portal. For those that have invested with TaliMar Financial, you're probably familiar with logging into our lender portal to view some of the trustee offerings that we have, as well as being able to review the details of the mortgage fund. And then at the end, we'll talk a little about, we'll give a Q&A session there. All right, So a little about myself. I am a graduate of the University of Michigan Wolverines. No, not Michigan State. And no, I am not a fan of Ohio State. I'm a big Michigan football fan. I graduated political science and history degree from the University of Michigan, and then went on to the technology industry where I was during the dot-com era, and then got into real estate in early 2001. I've done coursework in real estate finance and accounting at the University of California, San Diego. I started in real estate finance in 2001 as a financial analyst for KeyBank Private Equity Group. And essentially, I was the guy that as new opportunities came in, I'm the one that was putting it into the spreadsheet, doing all the cash flows and whatnot. And what we did at KeyBank was to provide what's called mezzanine debt, or some call it joint venture equity. We would partner up with home builders at that time and provide the equity they needed to build out small to mid-sized development projects. It was a great opportunity. I learned a lot, met my first mentor there. It was a great opportunity until about 2007. Its focus was on housing. Obviously, with the housing collapse, they decided to fold that group. And I went on to working at the Federal Deposit Insurance Corporation, many of you know as FDIC. They're the ones that insure your deposits at a bank. Had, again, an amazing experience. I was on the team that would actually go out to failing banks. You probably may have seen this on 60 Minutes. And we would actually physically go in on a Friday evening. We would shut the bank down. We would then underwrite all their loans. And then we'd actually sell those loans off to the private marketplace. So I got to see the guts of big, medium, and small size banks that were failing. I got to see all the horrific loans that they were doing, and I got to actually travel the country. So it was a great 2 years. It was a lot of work, a lot of time involved, but a great education. About that time, around 2008, is when I established what is today TaliMar Financial. I was actually lending money at that time to real estate investors that were buying houses at foreclosure sales and from bank-owned properties, which were very popular between about that 2008 to 2012 timeframe. I was doing that with my own money for about 2 years, and then about 2010 is when I started bringing in outside investor capital. And then established TaliMar Income Fund 1, and actually it's not 2001, but 2021, last year. I hold a California mortgage broker's license, and I am a certified fund manager through AAPL, also known as the American Association of Private Lenders. It's a certification that they provide to fund managers. It's a class that we take on the basic processing of and developing and managing of mortgage funds. In fact, I'm going back for another class next week to get what we call our Certified Fund Manager Plus, essentially Fund Manager 2.0. So I'm excited to be going through that class. And that's hosted again through American Association of Private Lenders. And it's done by Gerasi LP, which is one of the largest fund management or attorney firms that handle the development and processing of mortgage funds. Currently live in San Diego with my wife and 3 children. And when I'm not in the office, I play competitive tennis. So if you ask anybody that works within the company and I have lost a match, it is not a good day the following day. Okay. So a little about TaliMar Financial, the company. I established TaliMar Financial, what is known today effectively, in 2008. Started just using my own cash to funding hard money loans to local residential real estate flippers. And then about 2010 is kind of when I used all my money up and started bringing in outside capital to put those loans together. We're located here in San Diego, and we have 5 employees here in the United States. We also have employees in the Philippines and a software development team in India. We have funded over 850 loans to date, totaling over $325 million. We currently service 93 loans with an outstanding balance of over 53 million. So we actually what we call master service that 53 million through our servicing partner. We established TaliMar Income Fund 1, and I'm going to use the term TIF1, which is the acronym for TaliMar Income Fund 1, in 2021. Really, the primary reason why we established TaliMar Income Fund 1 was that we had grown so big so quickly, it became very difficult to manage over the 2,000 investors that we have, to piecemeal all of the investors in each one of the loans, and then to service that loan portfolio of each investor in each loan. I think we calculate we had about an average of 4 investors per loan. So you're talking about 350 plus investors, active investors in our entire portfolio. And to manage a portfolio and to scale a portfolio like that just becomes too big. In fact, we developed software to assist us in managing a portfolio of fractionalized loans. And again, it just became overwhelming, which is why in 2001, we established TaliMar Income Fund 1, our mortgage fund, and really had all of our investors invest in the fund, and then we can lend out from the fund. That has allowed us to do a couple of things. Number one, scale. Also for our investors, is provide kind of a more consistent platform to invest in trust deeds. No longer were our investors, trying to sign up for trust deeds within minutes. That's about how quick those trust deeds would go. They could just invest the amount of money they wanted to at the time they wanted to, simply invest that into the mortgage fund. Additionally, it offered our investors the ability to compound the income, the interest that they earned from the fund. Instead of just receiving money every month, they could reinvest those funds. So currently, TIF1 TaliMar Income Fund 1 consists of 40 loans totaling over 23 million. Now, some of you are going to ask, well, why, Brock, is there only 23 million in the fund, but you manage 53 million in total loans? The difference there is simply the 30 million difference is that those are we call legacy trust deeds. So those are loans that we funded prior to establishing TaliMar Income Fund 1. That 30 million will, as those loans pay off, they shift in, the funds get shifted into the fund. The weighted average coupon, a term that I'm going to use, the WAC of the portfolio right now is 8.2%. Now, what's interesting is just within the last, I'd say 9 months, maybe we're going to maybe 10 or 11 months now, that weighted average coupon, the average interest rate of the loans in the portfolio, we were averaging just shy of 7.5% just 9 months ago. So with the rise in the Fed rate, you can see that there has been a significant rise in the return of the portfolio. Now, for a manager, a fund manager, it's difficult to get the return of the fund up really quickly, because you have a lot of these legacy loans, these loans that you funded over a year ago that are returning lower dollar amounts. To get those out of the portfolio, they either have to be paid off and made, bringing in higher yielding loans, or you can sell them off. And one of the things that we have is we have a huge investor base, and we can sell a lot of those lower yielding loans off to increase the return of the portfolio. And that's kind of the value add that our fund, that our platform offers. We can offer that dual platform. And that's why some of you have seen a lot of the emails that have gone out that we're selling off some of these loans, and it's been a huge success over the last 30 days. And then we did receive the highest designation our fund did of verified gold from Verivest. Verivest is our fund administrator. They're physically doing the accounting and monthly statements and whatnot for our fund. They do a full audit of TaliMar Financial. They review the principles, background checks, experience, education. Then they review our entire portfolio to ensure that what we said we have funded. And then they issue a verified goal. So we're super excited to be having that designation from our fund administrator. All right, so let's go ahead and get started into what we're going to talk about today, is really kind of what is a mortgage fund. So a mortgage fund, I like to compare it to the relationship of a bank, its depositors, and its borrowers. So at the very basic level, you have investors, okay? And those investors invest in a single fund. Many people use the term pool, okay? And that pool, that fund, then lends the money out to real estate, in our case, real estate investors, our borrowers. Now, our fund focuses on single family, multifamily, and small balance commercial in the Southern California market. But funds, there are all size, scope, target market funds. There are some funds that focus on doing first trust deed mortgages, like our fund. Some funds focus on second trust deed mortgages. Some focus on just single family short term. Some fund maybe just doing high balance commercial loans. Every fund is a little different. My recommendation is, if you're interested in investing in a fund, make sure you find a fund that is investing in what you feel most comfortable. Don't just simply look at what's the highest returning fund. You don't know if they're doing seconds in Nebraska, which is probably why they may be getting a higher return, or maybe you want to be more conservative and be in first in core markets like Southern California, which is our fund. So again, the fund is simply just made up of various investors as members of that fund. Most funds are just simply an LLC. You become a member of that fund. That fund is then managed by the fund manager. In our case, that's TaliMar Financial, and they are the responsible for funding the loans. Now, the way investors make money in a mortgage fund is just like a bank and its depositors. When that fund makes a loan, those borrowers then make payments back to the fund. That fund processes those payments and then distributes those proceeds back to the investors. Now, you as the investor have the choice of either taking a monthly distribution or reinvesting those funds back into the fund, back into the mortgage fund. So that's why I like to say, look, at the very basic level, it's like being a depositor in a bank, and the bank is taking your money and lending that out, and then taking the proceeds from the borrowers and redistributing it back to you as interest income. Now, the fund industry has blown up since 2008. When I say 2008, it has grown substantially. In fact, it is now a multi-billion-dollar industry. After 2008 and the collapse of the housing market, banks became very conservative in the types of loans that they funded. Not only was it a requirement by the federal government of what banks can fund, banks just generally said, look, we're going to be out of the business on as much of a big scale to investing or lending to real estate investors. That left a huge void in this lending industry. So where you would have this what we call private lender or mortgage or hard money lending industry was really kind of based upon private investors putting money into a loan. Maybe it was one lender or one investor or fractionalized investors into funding a loan. You started to see huge investment groups getting into this space. Companies like Blackstone, KKR, the Carlyle Group, Vista Equity Partners, these huge private equity funds started to establish effectively their own private lending market. And so starting about 2012, 2013 is when I started to see these big dollar hard money lenders coming into the marketplace, really focused on funding the fix and flip industry and funding the construction loan industry. And that is why a lot of people that have been investing in trust deeds saw a significant decrease in the yields that they were earning on their trust deeds. It's because a lot of these more traditional mortgage brokers who were offering hard money were having to compete with these huge groups. And these groups were national, and they came on very quickly. So where I was funding in 2012, hard money loans at returns maybe in the 9 to 10% range, at least here in Southern California, know that rates completely change all over the country. So, if you're in Southern California, very competitive. Rates have always been lower in the Southern California market. But when you start to get into the Midwest, where the loans are lower and lower in size, but a little riskier in terms of the markets, the returns can be a little higher. They came into these core markets of Southern California and drove rates down. So I'd say at the base level, we were having to compete with these groups and offering trust deeds at 7.5%. And trust me, I was getting a lot of feedback from investors at the time when we were offering yields at that low of rate. Now, this, however, effectively changed the landscape of how trust deeds work. So again, I'm going to go back to these trust deed investors, and I'll kind of explain to you what a trust deed investor is for those that are not aware of it. What happened was you created this whole industry to compete with these groups of the mortgage fund. So now groups like myself, brokers that would offer one-off trust deeds, in order to really compete and scale, you had to create a mortgage fund. And that is why we launched our mortgage fund in 2021. But it is a very, very big and growing industry, and it'll continue to grow as banks become more and more conservative on their lending. And in order to fill that niche, groups like ourselves have come in and provided the capital real estate investors need to purchase investment properties. So I talked about a mortgage fund, and we're going to compare a mortgage fund to a trust deed investment. People that are not familiar with what a trust deed investment is. A trust deed investment is simply you are the lender and you are lending money to a borrower using their real estate as collateral. You are essentially doing a one-on-one transaction. You are lending the money to this borrower, and that borrower is paying you. Now, that's at the most basic level. What most happens is there's a broker involved, such as TaliMar Financial. We actually originate that loan, and then we present that loan to you, the investor or investors, and then we manage that loan on your behalf. So we're responsible for collecting the payment and then pushing that payment onto you. Now, that was a very popular way of investing in trust deeds up through, let's say, 2012. But as I mentioned earlier, you had a lot of these large private equity funds come in, and this type of investment became very difficult for brokers to compete. And so a lot of brokers moved to this mortgage fund model. And the advantage for a broker on a mortgage fund model is that when we get a loan request, we don't take that loan request and then go off to our investors and see who wants to invest in it and then get the money and then go and fund that loan, which is a very inefficient process. And for borrowers and brokers that bring deals and loans to brokers like myself, get very squeamish on this kind of platform because they're not confident that the broker is going to be able to find the investor to fund their loan. Hence the mortgage fund. Okay, the mortgage fund, and on the other hand, is you're investing in the fund. All right, so you're depositing your funds in the bank, and then that fund is lending that money out on your behalf. Now, there's significant advantages of this for both the investor and the fund administrator, the broker, and the borrower. And we'll get into what those pros are. But this is really the big difference between investing in a trust deed, so you are direct with that borrower, versus investing in a fund, which is really a pool of mortgages. So you, the investor, are diversified over a pool of mortgages. I see a question here. I'm going to go ahead and see what the question is. Realizing that mortgage funds are inherently illiquid, and I'm actually going to get into that, but I'm wondering your current and future plan liquidity options are in TIF 1. I currently an investor with a mortgage fund, and they have a 1-year lockup period, and I'll get into this liquidity. It's a really good question with liquidity option that depending on the market and timing of the fund's ability to return. So I'll jump into that question, but great question. So now we've discussed what a trust deed investment is and a mortgage fund is, and compared the two. So here are the advantages. And you can tell the advantages are very scaled and very weighted towards the mortgage fund. Number one, and I think the most important for an investor that wants to invest in mortgages, is you've reduced liability. Okay, so if you are investing as a trusted investor and you're lending money to a borrower and that borrower stops making payments, you have to go through the foreclosure process. Okay, now if you were invested in a fund, the fund manager would be doing it on your behalf. We specialize in doing it. We're going to do it for you. Not saying that we're not going to help you on a trusted investment. We can set you up with the right company to help you with the foreclosure. But at the end of the day, if that borrower decides, hey, you did something wrong, and trust me, in California, it's going to happen, they will sue you, and you are going to be on the hook for the litigation. Now, you may be in the complete right? And I'll tell you some stories about where we've been involved in this, but anyway, they will find an attorney and they will sue you directly. So that is the number one reason I suggest, if you are not a professional investor in trust deeds, why you should stay away from them and put your money in a mortgage fund. Now, the other reason I suggest a mortgage fund is you're diversified over a portfolio of loans. All right, so when you invest in a trust deed, your money is on that trust deed. If that borrower stops making payments, 100% of your income is stopped. Okay, now if you're invested in a mortgage fund, that fund could have, for example, 40 loans like TaliMar Financial. And if that one loan stops paying, one of the 40 loans stops paying, that's okay, because you've got 39 other loans that are paying. The consistent investment platform. Now, this is one of the reasons why we went to a mortgage fund platform. As we grew, we were doing 15 to 20, I would say, let's say 10 to 15 loans a month. Okay, so if each loan had 3 investors in, we had a minimum of 30 individual transactions that we had to do per month. And I can tell you, Sarah in my office, it gets driven crazy when she has that much paperwork to manage. And so in an effort to again create a more consistent approach, an efficient process of funding loans, we said, okay, we're at a level and size where the mortgage fund makes much more sense. Additionally, investors were getting very frustrated being that they couldn't get invested in a trust deed. So maybe we posted a $100,000 trust deed, it would snap up in minutes. And I had investors calling me saying, that's not fair, we can't get invested in there. And there was nothing I can do. I have to make that trust deed available to all my investors. Additionally, some investors only had 50,000 while others had 75, maybe 45 or 100. And you started playing Tetris, trying to piecemeal all the investors together in any given loan. So for us, that became extremely burdensome. The other advantage is that it was the fund is a much more passive investment strategy. I talk about you can invest when you want, how much you want, and we'll talk about liquidity, but you can get your money out when you want. Okay, in a trust deed, you need to have the amount of money that trust deed is required, the loan amount or a piece of it, a fractionalized piece of it. You got to be quick enough to get involved in that trust deed. That means that you have to underwrite it, look at it, make you comfortable with it. And if you ever wanted to get your money out, you would have to wait for that trust deed to pay off. So it's a much more passive investment strategy. And then you just have access to better loans. I promise you, I get better loans, and better loans doesn't mean a higher yield. So I think a lot of people say, well, Brock, you don't offer as high yield as the loans I'm getting. I can promise you I am getting better loans because mortgage brokers and borrowers want to work with a mortgage fund. They want the comfort and knowledge that that fund has the money to fund their loan when they need to close on the property or if they need to refinance it, versus a trust deed investment. They hope that that broker finds the money to put to fund their purchase or their refinance. Also, a lot of my borrowers get concerned when we don't have, at the end of the day, actual control over the loan. So if we had to, let's say, extend the loan because the borrower, in our case, let's say they have a fix and flip loan, they finished their renovations, the property is listed on the market, they've been making payments on the loan the whole time, there's a clear exit, where I would suggest that we would extend the loan because it's a great loan. They don't know if the trust deed investor that's actually the money in the fund needs that money back tomorrow. Okay, and so for investors that are sophisticated, or borrowers that are sophisticated real estate investors, they know the difference. These are experienced investors who ask that question. Are you a direct lender through a mortgage fund, or am I going to be dealing with a trustee investor or investors on my loan? Also, and I will argue that a mortgage fund is more liquid than a trustee investment. So in a mortgage fund, you've got, in our case, you have 40 loans. Okay. So in order to get your money back out, two things need to happen. The first is either a loan has to pay off. So there's better chance that one of the 40 loans is going to pay off to get you your money back versus that one loan that you have to wait to get repaid. So that's why I say it's a more liquid investment, or more investor dollars come in that will replace your withdrawal. Now, there are advantages of a trust deed investment, and the major advantage of a trust deed investment is that you just have more control. You get to see the loans, you get to build your portfolio, and you get to invest in the loans that you want to create for your portfolio. However, it is a lot of work to do that, and unless you are a professional trust deed investor who has a big basket of brokers that are bringing you loans, it's really difficult to get those loans. And trust me, by the time that you get that loan, it's probably gone through a couple of mortgage funds that have probably denied the loan and have gone to that mortgage broker and willing to go on the trust deed route. So those are some of the advantages and disadvantages of a mortgage fund and a trust deed investment. Now, I kind of reiterating the fact of what are the advantages of a mortgage fund? And these are the main items that I want to cover. So the advantages of a mortgage fund is, number one, is consistent monthly income. And I'm comparing this against other investments like the stock market, or investing in gold or artwork or something. This is what the advantages of a mortgage fund can offer. So number one, they're going to offer you consistent monthly income. So you're going to get a check every month or every quarter based upon how that mortgage fund is structured. We do monthly distribution, but a lot of mortgage funds will do on a quarterly distribution. Number two, liquidity. Okay, so mortgage funds in a good market can be extremely liquid. When the market does, when there's extreme volatility, mortgage funds can become illiquid, and I'll get into how they become illiquid. And we'll talk about some of the headwinds that some of the mortgage funds will have. Diversification. So you're not, when investing in a mortgage fund, it is a basket, a pool of mortgages. As long as you're confident in the underlying mortgages and the real estate that are securing those mortgages, you get a much more diversified portfolio. Where this probably doesn't help out is, coming out of 2008, there were some recent mortgage funds that had a real difficult time when they were funding land development deals, construction deals, and land, just pure land. And then I'll get into why those are really funds that you probably want to stay out of, or maybe reposition some of your investments out of funds that are heavy on those kinds of loans. Again, you have the security of real estate. And I say that because, look, we focus on single family, multifamily, and small balance commercial loans in really the Southern California market. But if you were to look at our portfolio, it's in the San Diego market. I am confident over the long term that values are going to hold in core California markets like San Diego, Los Angeles, and yes, San Francisco, I do believe. You can earn compounded interest. And this is really important, a factor. And, something that I didn't even consider when I invested in, or when I launched the mortgage fund, but an investor had made a very good point of this. When you reinvest, when you invest in a trust deed, you're going to get a monthly payment, okay? But there's nothing you can do with that monthly payment. Maybe your monthly payment's $600 or $700, unless you're using that to live off of, which I highly suggest don't invest in any investment if you are needing the money to live your lifestyle. But you get that money dropped in your account, and there's nothing you really can do with it until you accrue enough money to invest in your next trust deed. So it just sits there, it doesn't earn any interest. The nice thing about a mortgage fund is you can decide to reinvest those funds. So now your $100,000 investment that you made, maybe you made $1,000 that month, you are now earning interest on $101,000, and then $102+ thousand every month. So it's accruing. And at some point, maybe at the end of the year, you want to liquidate some of your funds, you can always go back and liquidate your position in that mortgage fund. And then the tax advantages. So that there's some significant tax advantages that that are offered by investing in a mortgage fund, such as how we're structured, and I'll get into that. Looks like we got another question. I'm going to go ahead and jump in there. You're at 23 million now. At what point do you expect to have more difficulty sourcing loans of needed quality, et cetera? 100 million, 200 million. I know that's a lot of competition out there for these loans. So yeah, great question. So I would say that we would have enough deal flow in just San Diego alone at probably up to 75 million. Right now we're at 50 million. And the only thing stopping me from getting up to that 75 million is just having enough confident that we have enough capital to fund incoming loans. So I would say 75 million. If you looked at one of the larger mortgage funds in San Diego, they're up to 185 million. And those are loans primarily in San Diego. However, they had a much more exposure to large construction loans, which is we're not focused on doing large construction loans. I like to say we hit a lot of singles, so a lot of single family homes, a lot of small balance multifamily. I mean, in fact, our large, our average loan size in the fund, I think, is about 600,000. So you can imagine how many $600,000 loans you would have to make up 180 million. But yeah, so that's a great question. 75 million in San Diego alone. And then you start to get into markets like Los Angeles and San Francisco. And trust me, we're looking at that every day. And, when we look at our future and we do our future projections, we take that into considerations. Do we have to expand into other markets? But I'll tell you, I know San Diego market very well. For 14 years, this is where I've been underwriting loans in the San Diego market. All right, so let's go to the next one. So one of the advantages I talk about is consistent monthly income. So remember, the mortgage fund is created by a pool of mortgages. And so here on the left-hand side, we have all of our mortgages. And every month, that pool of mortgages makes their monthly payment. Those payments go into the mortgage fund, get processed, and then are distributed out to the investor every single month. I had mentioned earlier, you have two options on your distributions. You can either reinvest those distributions back into the fund and get compounded interest, or you can have those investments deposited into your account. Now, compare this if you're a trusted investor. So in a trusted investor standpoint, you have to take the monthly payment in most cases, unless you structure the loan to just take a bulk payment at the end of the loan. And when a loan pays off, all the principal and remaining interest gets put into your account, and you don't earn any income on that loan until you find another trustee. And let's hope that trustee, is either the same dollar amount of the value of the amount that was deposited into your account or close to it. Because if it's too big, if the loan is too big, you can't fund that loan, or if it's too small, then you still have principal still left in your account, not earning interest. That is different than in a mortgage fund. That mortgage fund, you invest your 100,000 or 500,000 into the fund, it's constantly working. Okay, so you're constantly invested in the fund, and it's up to the fund manager to ensure that he's getting the money out into good loans. So that creates more consistency on the income. Now, some people say, well, Brock, I'm earning 10% on my individual trustees. That's great. And on individual trustees, you probably can find that right now. But how much income do you lose when that money is deposited in your account and you're looking for your next trustee? And people underestimate the income that they lose when that happens. Liquidity. Now, this was the question that was raised earlier. So people ask, well, Brock, how do I get my money back when I invest in your fund? And there's really two ways you get your money back when you invest in a fund. Either a loan pays off, so one of the 40 loans that we have in our mortgage fund pays off, or another investor pledges money. Those funds are then made active, and then they go to pay you off. Those are the two main ways that they remain liquid. Now, in a normally functioning market, we have loans paying off all the time. So as long as that your dollar that you're asking for isn't some huge dollar amount, we just wait until a loan pays off or investor dollars come in, and then we go ahead and distribute the funds to you. Now, when the markets do, when there's a lot of volatility in the market, or you have a loan portfolio that has a high percentage of loans that are either in default, or you've got a large, and we'll talk about this, a large number of construction loans that aren't going anywhere, you don't have a lot of money coming into the fund, okay? And so you're gonna have to wait for that withdrawal until one of those projects are completed. I talked about back in 2008, there were some large funds here in San Diego that had significant issues on doing withdrawals because they had funded land development deals. And in 2008, it was lights out on land development deals. It was lights out on land. It was lights out on construction loans. And that's why I talk about today, when you look at the fund, if you're invested in a mortgage fund now, I would immediately go and ask the fund manager, how much exposure do we have to land? How much exposure do you have to land development loans? And how much exposure do you have to construction loans? And then make an educated decision if that's still where you want to be. The reason why a lot of the funds got overweighted in those kinds of loans over the last, let's just say 2 or 3 years, is because these large, again, we talked about private equity funds came in and drove rates down. So what happened was, in order to keep investor returns high, they went into loans that they may have not otherwise done, which includes construction loans, land development loans, and a high exposure to land, which have traditionally have paid a higher yield. But there's significant risk involved in those kinds of investments. So if you looked at our portfolio, we've got no exposure to land. We had one construction loan. Construction is done. They've got it listed on the market. And then we don't do land development loans. We're doing singles every day, trying to put single family, multifamily type deals. So again, liquidity is probably more liquid than trustee investments in a market that is good. But when the market slows down and you don't have a lot of loan payoffs coming in or investor pledges coming in, you're going to have to wait for the withdrawal. The other thing to note on withdrawals, and this is really important if you're invested in another fund too, we have up to 90 days to issue you your withdrawal. And that's the time frame. I think we've had 4 or 5 withdrawals in the fund over the last 18 or 20 months, and we got it back in within 36 hours. But you technically have up to 90 days. After 90 days, you have to do what's called a lockup. So you lock up the fund and don't allow any withdrawals until you effectively can. The other thing is with withdrawals is that it has to happen. It's based upon who asks first. So investor 1 comes in on the 1st of the month and says, hey, I want my 100,000. The next investor comes in on the 10th and says, I want my 100,000. Well, I've got to get my money back to the investor 1 who asked first, and then the subsequent down. So that's another big thing that you want to ask for if you're in a fund. There are these, you can have what we call side letters with investors. The term side letter simply means if you have like a big investor come in and say, okay, I'm going to invest $10 million in your fund, but I want to have either get a higher return on my money. I want to have be first out of any withdrawals or something that they want some negotiated option. Your fund manager has to let you know about that. So they should always disclose all side letters. The only side letters that we have in our fund right now, number one, is we waived our lockup period. A lot of funds have a 12-month lockup period. So once you invest your first dollar in, okay, most funds have a lockup period where you cannot make any withdrawals for a period of 12 months. We've gone ahead and waived that requirement. So that's a typical side letter that we would offer. So my suggestion is, you're in a fund right now, ask to review any side letters that fund might have. Okay. I'll go into, there's a question about loan to value ratios. I'll go into our fund and loan to value ratios. And then going back to the original question of do they have a 1-year lockup period, as I had mentioned, that we have waived that lockup period. And the reason being is that a mortgage fund is relatively liquid. Lockup periods, I would say, have more to do with if you're investing in a fund that might be buying real estate, and it's not that liquid. It's only liquid when you sell a piece of real estate. In a mortgage fund, you're constantly having payoffs and you're constantly having investor capital, in most cases, coming in, so you can typically get those withdrawals out. How are we doing on time? Okay, perfect. Okay, so we talked about diversification. So a mortgage fund is made up of a pool of mortgages. In our case, it's made up of roughly 40 mortgages. What's nice about that is that if one mortgage stops paying, you have 39 other mortgages that are paying. So you still have those borrower payments coming in and those investor distributions going out. So you're diversified. Now, compare that with a trust deed. As I mentioned earlier, the trust deed, if that borrower stops making payments, 100% of your income stops. Okay, so the diversification is a really key component of a mortgage fund. The other thing is that when one loan pays off in a mortgage fund, again, your income still comes from the other 39 loans in that fund, in our case. If you're an individual trust deed, when that loan pays off, those distributions get placed in your checking account or in your account. You don't earn any interest on those funds until you can get them back out. And that might be a couple of days, could be a week, could be a month, for all you know. The security of real estate. So when we talk about the security of real estate, the fund, the money that is lent out to the investors is secured by a deed of trust on the property. Okay, so that is the security of the mortgage fund. So if that borrower goes to pay off that loan or refinance that property, our deed of trust is recorded on the property as our security, and that borrower, if they're intending to sell the property, has to repay that loan so that we will release our secured interest on that property. That is the security. Now, if you're a trust deed investor, just replace mortgage fund with you. You are on that deed of trust secured on the property. So that is your security by investing in a mortgage, or the mortgage fund's security in that property. Your security is a membership interest in the LLC. So we have TaliMar Income Fund 1 LLC. When you invest in the mortgage fund, you become a member of that of the fund. And that is what reduces your exposure or reduces your liability against any borrowers that might sue the fund. You're a limited liability member, or a member of the limited liability company, versus if you are a trust deed investor, again, replace yourself with a mortgage fund, you can be directly sued by that borrower. One thing to note is that people ask, well, Brock, how do I lose my money? And we'll get into kind of where the issues are. Now, one of the scenarios is if that borrower stops making a payment on the loan, just like a bank would, we would initiate a foreclosure action. Now, in that foreclosure action, the borrower has the opportunity to make good on the payments, or if it's a maturity default, extend the loan, or just pay off the entire loan through the sale of the property. But there may be a case where we foreclose on the property and we own that property. Now that property becomes an asset of the fund. So when people talk about, well, do I lose all my money? No, because unless you think the value of real estate is going to go to zero, you actually have an ownership, or the LLC has an ownership interest in that property. And then it's up to the LLC to do whatever to pay off to sell that property. So we talked about compounded interest, and I want to show you how important this is, or how powerful compounded interest is when you invest in a mortgage fund. So in this case, I wrote investor 1 and investor 2. And in this case, you've got the beginning balance of $100,000 and $100,000. So each investor starts with $100,000. Now, let's just say the fund returns at a net return to the investor of 7.75%. Okay, each investor gets that same amount. They're invested in the same fund, and they're earning the same return. But the difference between investor one and investor two is investor one took their distributions and had them deposited in their checking account. The investor two, on the other hand, reinvested every month. So they reinvested the proceeds back into the fund. So in the first month, each investor got $645. Now you can understand if you invested $100,000 at 7.75%, your payment is $645. If you're intending to reinvest $645, you're gonna have to wait a long time to reinvest those funds until you accrue enough to put it into your next investment. Well, investor two understands that and says, okay, well, I'm not going to do much with $645. I'm going to go ahead and just reinvest those proceeds back onto the mortgage fund, and it'll just be tacked on to my principal. Okay, so this investor added zero, and then this investor reinvested 100% of the proceeds. So their ending balance at the end of the year, this investor took his proceeds. So his ending balance in the fund is $100,000. Well, this investor ending balance is $108,000. Remember, they're accruing after the first month, that's $645, and then it just grows from there. So at the end of the month, their principal balance in the fund is $108,000. So this investor return over the year earned a good solid 7.75%. Great return. Those funds are deposited into their account, and their money is just sitting in their checking account until they reinvest those funds. Well, this investor actually earned a compounded interest return of 8.03%, over a full 1/4% higher. And that's why I talk about why compounded interest is such an important factor when considering investing in a mortgage fund versus maybe investing in trust deeds. Okay. Now, like any investment, I want to be fully transparent. There are risks of investing in a trust deed, okay? Or I'm sorry, in a mortgage fund. Well, in a trust deed as well, but we'll talk about investing in a mortgage fund. All right. So as I mentioned before, every mortgage fund has kind of a different focus. All right. So again, some are very localized. Hey, you invest in Southern California, or they fund loans in Southern California, some on the West Coast, some all over the nation, some in the Southeast. It's whatever the fund manager feels is probably the best option based on their experience and kind of how they've created their company on the best options. Now, we are focused on funding within the Southern California market, though our fund allows for all of West Coast, on single family, multifamily, and small balance commercial. Okay, I don't go funding loan. I'm not funding loans on the East Coast because I don't know the markets on the East Coast. And the loans on the East Coast have a tendency of a smaller loan size, and I just prefer to lend in a market that I know, a little larger of loan sizes. But the risks in the mortgage fund is really at the loan level. Okay, are you as an investor comfortable with what that fund manager is lending in? If you're not comfortable about investing in Ohio on small balance single family houses, right? Even though it's a higher return, don't invest. If you're not going to invest your own money on it, I would not suggest investing in a mortgage fund that focuses on that. Same thing with like construction loans. If you're not comfortable about funding construction loans directly, don't invest in it. It's not worth losing the sleep. It's not worth earning another 2 or 3% on your money. If you're not comfortable with it, don't do it. So the risk in a mortgage fund at the loan level is, number one, a high percentage of defaults. Okay, you want to make sure you understand how many defaults are in that portfolio. There's no fund manager that's ever going to have 0 defaults for eternity. Right now, we have 0 defaults in the fund, but that could change. Okay, we don't bat 100% on every single loan. And I always tell investors, look, things change for a borrower after you fund a loan. They may be great day one, but something happened in their life where they can't make those monthly payments. Just hopefully that loan, we can get out of that loan as quick as possible. So the risks are high percentage of defaults. When you have a high percentage of defaults, usually you don't have as much income coming into the fund, and that'll drive the rate of return down on the fund. So defaults occur either the borrower is making late payments or haven't made payments, or there's a maturity default. Maturity default simply means if the loan was underwritten for 12 months and the borrower goes beyond the 12 months, that is a maturity default. The number two risk, the underlying value of the collateral drops below the balance of the mortgage fund. This is the worst thing that can happen. All right, let's just say I have a mortgage fund of $100 million and it's secured, the $100 million is secured against real estate that's worth $200,000, okay? We call that loan to value ratio. And I'll even make it easier. Let's just say 100,000, mortgage fund's 100,000, and you've got real estate that's worth 200,000. Okay, so that's what we call loan to value. There was a question about what you look at loan to value. That's 50% loan to value. 100,000 in your outstanding loans to value of real estate of 200,000. Well, if the value of the real estate drops, right, you get more risk. There's more risk involved. So if I foreclosed on a property, if I had a loan of 100,000 and the value of the real estate's worth 200,000, there's a high likelihood I'm going to get my money back if I had to foreclose on that property. Now imagine you multiplied that by 100. Okay, so you've got 100 loans, each at 100,000, with 100 properties worth 200,000. Okay, now what would happen if the value of that real estate went down to 150,000? Well, now there's only $50,000 of equity left in each one of those loans. Okay, so the issue starts to occur is when the value of all those assets, those properties, right, fall and equal to or go lower than the equity in the mortgage fund. Okay, and that's going to happen traditionally. It happens when a mortgage fund is heavy in second trust deeds. So those are loans that are behind a first being paid off. If the property is sold, the first gets paid off first, and then whatever proceeds are left to pay the second. Okay, that happens when a portfolio is heavy of seconds. It happens when a portfolio is heavy with real estate. With construction loans, because the value of that property, if it's a construction loan, is only as good as when it's done. Okay, there's really very little value to real estate if you have a project that is half built. All right, or land. So in terms when the market becomes very volatile, people are not buying land because they don't want to build into the future. There's very little value to land at that time. So that's why value of land goes up and down so much so quickly, is because in good times when people are buying land up to build houses, it becomes very valuable. But if nobody is building houses, that value of land can drop considerably very quick. And then we talked about like land development loans. So same thing with construction loans, right? I mean, if you're in the middle of developing a piece of land to build houses, and the value and people stop buying homes, there's very little value to the land that you just developed. So you want to understand what the underlying collateral for the mortgage fund is. And then liquidity. Okay, this is a big risk. I talked about how it could be a big advantage, but it can also be a risk. So let's just say you have a run on the mortgage fund, like a run on the bank. So all the depositors go running into the bank and they all want their money. Well, we know that the bank has lent the money out already. It's not that they, if you've got $1 million worth of investor capital in the bank, and that $1 million is lent out, and everybody just says, hey, I want my money out right away, it becomes problematic. People are going to have to wait. We talked about that 90-day rule. We have up to 90 days to make withdrawals. And if we don't do it, we have to lock up the fund. That is what's going to happen. So in 2008, that's what happened with a lot of mortgage funds, just locked up the funds until they got the properties paid off, and then they were able to get the investor withdrawals out. Now, you're going to have less of an issue in the liquidity issue if you're invested in assets, real estate types that typically move much quicker, like single family homes, multifamily properties. In fact, during the 2008 crisis, a lot of the funds that were focused on rental properties, like single family, multifamily properties, and the borrowers had a tendency to continue to make those payments because they had rental income that was coming in to be able to cover those payments. The issues occurred for the funds that had a lot of construction loans or land development loans. Those were the funds that really got into trouble. So again, the risk of the mortgage fund, if you get a high level of defaults, so you don't have a lot of income coming in to pay the investors, If the underlying collateral of the mortgage fund drops below the actual invested capital in the fund, or if you have a run on the fund. So, a lot of people ask for all their money back right away. But there are ways that we can mitigate our risk as a fund manager for these things to not happen. So these are the things that I've actually deployed or employed ever since I started my trustee, started TaliMar Financial. Was number one, know your market. Okay, the market here in San Diego is so different than Tampa, Florida. Okay, that's why I'm not investing or funding loans on the East Coast. I just don't know the dynamics of the market. I don't know what drives the market, but I know what drives the market here, and I'm confident that long term, the market that market in San Diego, over the long term will continue to be strong, simply because we have such a supply and demand imbalance. The other thing is know your borrower. Okay, this is really important. I can almost done so many loans now. I can listen to the borrower on the phone and almost tell you if they're going to be the right person for us to lend to. It's just the way they talk. It's just the way that why they need the money and their ability to kind of say, hey, my bank, we were going to fund a loan, or we were going to close on a property, but my bank decided not to fund the loan the last minute. Here's the reason. This is why I can make the payments. And Brock, this is how I'm going to repay your loan. If they can say that to me, I feel relatively confident before I even start looking at their financials and their credit. I can already tell you, yeah, this is going to be a good loan, versus the borrower that's calling up says, look, I need the hard money loan because I've been missing some payments on my credit cards. My revolving credit isn't great. I'm hoping to refinance the property with a conventional loan. I can hear that on the phone. So you really have to understand the motives of the borrower and understand what risks you're going to take on the real estate that you are lending on. And that goes into focusing on strong property types. Again, I've really tried to stay away from land. It's something that I saw firsthand were the issues on a lot of these loans, especially when I was at the FDIC. And that's really where people and money was lost when they had money on land loans. And so we really just focus on our single family, multifamily, and commercial loans. Also focus on loan strength over portfolio yield. I understand. I talk to investors all the time that tell me, Brock, I'm getting 10 to 12% returns on my trustees. I hear you. Okay, but when you really dig into it and you start to understand why these, they're getting the 10 and 12%, you're finding out that they're second position loans. They're in tertiary markets. They're with borrowers that don't really show financial credibility. And so, we feel confident in really focusing again on asset types like single family homes and single and multifamily that just have demonstrated strength over the long term. And we'll sacrifice portfolio yield to really focus on that market segment. The other thing that people really misunderstand or don't focus on is your aggressive approach to loan servicing. I talked about how when you fund a to a borrower's situation can change. That could be after you fund the loan. That borrower could be great financially day one, but you know what? 3 months later, they get a divorce, they have a death in the family, the house burns down, or something occurs that they can't make those monthly payments. You need to be aggressive. Okay, having those difficult conversations with the borrower to ensure that they make the payments on the loan, that if they don't make the payments, that day 30, you are recording a notice of default. A lot of people, I get a lot of calls and say, hey, Brock, I can't make the payment this month. Just give me another 30 days to make the payment. I say, oh, absolutely. I'll give you my suggestion is you make the payment number one, but I will definitely let you make the payment in 2 months from now, but know that I'm going to record a notice of default. So just make sure that you're aware that I will be recording a notice of default, right? And so it's crazy how sometimes they're able to just get the payment in to you when you say, hey, I'm going to be recording a notice of default. So be aggressive on your loan servicing. We use technology to identify issues early and drive down costs. So this is really important. So we've developed internally software that helps us originate new loans. It helps us underwrite the loans, so doing valuations, looking for financial issues in the borrower's background. But then when doing the loan servicing, so we're constantly, reviewing markets, we're constantly reviewing valuations. We can identify very quickly if there's a notice of default. We can see exactly by minute if the borrower hasn't made the payment or not. We can see if they've called in the payment, all through the use of technology. And that's really been able to drive down costs because I have less headcount to manage a portfolio of this size. I mean, I can imagine 20 years ago when you're managing a portfolio of $50 million, 100 loans, you've got to have a pretty decent headcount of collecting the payments, making the calls to the borrowers, cashing the checks. Nowadays, it's ACH payments taken directly out of the account, automatically distributed out to the investors. Late payment letters are automatically distributed out. Emails are constantly going out to borrowers if they're late on payments. All of this by using technology. And then the other thing that I talk about is communication with investors. This is really important. Not every loan is going to go the way we'd hoped or we'd anticipated. But as long as you're communicating to your investor and explaining to them what the issue is and how you hope to resolve the issue, that communication typically makes the investor feel more comfortable about the scenario and feels confident that you're working on the issue itself. So for us, it's just being upfront, transparent, and communicating to the investors, good or bad, what is happening with their loan or the loan portfolio. Okay. So we're all aware of what the Fed is doing. We're all aware of the volatility in the housing market and what is going on with valuations. So here's some of the headwinds that I'm dealing with it as a fund manager. The number one is rising interest rates. Okay, it affects us in a number of ways. Number one, my investors are asking or demanding higher returns on their money. Rightfully so. You got the Fed raising rates. Therefore, that should have a direct correlation with the returns of the fund. The thing is it doesn't. Okay, the Fed raising their rate, yes, should push up the returns of the fund, but it's not like 1-to-1 ratio. Okay, there's only so much a borrower is going to pay for a loan, or you just lose borrowers. Okay, secondarily, I say that the rates on a mortgage fund are more driven by the risk an investor is willing to take, okay, to invest in your fund. So if I was paying out right now 5% on the mortgage fund, I would have no investors. Okay. Now I may have had investors 2 years from now or 2 years ago who, that there was nowhere else to put their money, number one. But number two, that's just kind of what the market was paying. Right now, you can go into treasuries and get a guaranteed return of 4%. Are you willing to take a risk to get to an 8%? And so that is really what drives the rates of a mortgage fund, is what is the demand of capital at that moment to invest in the mortgage fund. So rising rates has become a critical issue within the fund. That is why, again, you see us selling off a lot of the lower yielding mortgage fund, or a lot of the lower yielding loans out of the fund, so that we make room for higher yielding loans that we can put in the fund, which at the end of the day allows or increases the return to the investor. Number two, most mortgage funds, I didn't get into this, and if you got questions about it, I can more than answer it, but we have a credit line of the fund. Okay, we don't use leverage to boost the yield of the fund, but a credit line essentially allows you to deal with liquidity issues. So let's just say I have a large number of good loans that are coming into the fund, and I want to make sure I'm able to fund those loans. I may tap a line of credit from the bank to fund those loans and put them in. Now, as other loans pay off, I can use the proceeds from those loans to pay down the credit line. Why is that important? It's because if I get a large number of payoffs, all right, I don't want cash on the balance sheet. Okay, cash earns no interest. So it's just like you as a trusted investor may have a loan that pays off and you're sitting there waiting and looking for the next loan, but you're earning no yield, right? So that same thing happens to a mortgage fund. You may have cash sitting in the account and it's earning no yield, which drives down the return of the fund. Well, I can temporarily ease that issue by saying, okay, well, let me tap a line of credit. I'll fund this loan. And then when this loan pays off, I just pay off the credit line. So that's the reason for those credit lines. The problem, though, is if you're heavy on a credit line, let's just say you have a huge balance on a credit line, well, your credit lines are adjusting every month. So, for example, we had a credit line that we were paying 4% on the money, right? So I'm lending money out at 7.5%, 8%, but you have a credit line at 4.5%. So you've got that big gap, right? But now the bank is coming back and saying, okay, well, the credit line is tagged to the Fed, let's just say the Fed funds rate, and now we're paying 7%. For us, not that it matters, but we're not using the credit line to boost up yields. But I promise you, there are mortgage funds out there that definitely had a high use of credit lines. And if that credit line, they had a high use, right, and they had a weighted average coupon, let's just say the average interest rate on the loans in the portfolio were, let's just say, paying 6.5%, and now their credit line, the rate on the credit line's at 7%, they're upside down. If you remember the S&L, maybe some of the older investors remember the S&L crisis, a lot of these savings and loans had that issue. So they had a huge portfolio of loans that were paying a low interest rate. However, they were having to pay out their depositors a higher rate, and a lot of them folded. So, as a mortgage fund, I'm sorry, I'm right next to a hospital here. But as a mortgage fund, you don't want to be in that scenario. And so we're constantly looking what the yield or the interest rate of our mortgage of our line of credit is, and making sure that our mortgage fund is earning at least equal to or greater than that yield, and then not having to tap that credit line as often. Headwinds so those mortgage funds right now that have exposure to land and construction loans are really having a difficult time right now. So I would say that moving into the future, I would say there's going to be a lot fewer buyers of land, which means you're driving down the value of land. So that's going to be a tough one for mortgage funds that are heavy on land, and also construction loans. And that issue occurred probably about 6 months ago as we entered COVID, maybe let's just call it a year ago now, is with construction loans. They went into these loans with a set dollar amount for construction costs. Well, inflation blew up. Okay, it drove construction costs up substantially. You probably saw the cost of the price of lumber had increased over 100%. And so those when they went in, they had a set dollar amount of the construction loan. Well, all those budgets blew up, and so those borrowers had to go back to the lender and say, okay, well, our construction budget is no longer in line with really what needs to be used to finish the project. We need to increase the loan amount. Well, you had values of real estate going up. So you could actually say, okay, well, our loan to value ratio on the completion value is within line. So we're just going to rewrite your loan. Well, that's changed, right? Values of real estate have come down and costs have continued to go up. So these lenders were able to, once they were able to rewrite that loan because it kind of fell within their loan covenants, can't do that anymore. And so I anticipate over the next 6 months, you're going to hear about some issues on some of these projects, not being able to recapitalize themselves to pay the higher construction costs. Market uncertainty. So I think that there is some uncertainty in the marketplace in some of the markets. Now, I want people to understand that values of real estate over the last 12 months had already increased by 30%. And a lot of fund managers like myself recognize, obviously, that can't continue. Okay, you're going to have a pullback of something. So right now, if you looked at the San Diego marketplace, you're starting to see value. You're starting to see homes trading at a lower lower price per square foot than probably what was trading at the beginning of the year. However, right now you haven't seen a significant jump in either foreclosure activity, okay? And those people that don't need to sell, and I'll get into this kind of in a second, aren't selling. So coming out of the last 7 years, we historically have had the lowest interest rates ever, okay? So we've got a lot of homeowners that have locked in rates that are sub 3%. Okay, these are 30-year loans that are sub 3%. A significant portion of homeowners have been able to do that. Number two, We have a very strong employment market, especially here and I'm talking about San Diego. So what you're not seeing right now is you're not seeing a significant increase. Now, percentage-wise, you might see a significant increase in homes on the market, but in terms of total homes on the market, we're still at 30-year lows in San Diego on homes on the market. Homeowners don't need to sell right now. They got plenty of equity in their property, they're employed, and they're locked in at sub 3% rates or sub 4% rates on their loans. Where are they going to go? They're going to just hold on to that property. In fact, I would predict that the story 5 years from now is going to be that we can't sell enough homes in San Diego because they're all rentals. They're going to be great cash flowing investments for most investors who are locked in on a 3% rate. Why would you want to sell a house where you're paying 3% on your mortgage to a new house where you're paying 7% on a mortgage? It's not going to happen. So if you're in core markets, I don't think you're going to see the price fluctuations that the media is going to portray. But even if you do, I think that there's significant room, at least in our portfolio, should prices come down substantially. I think we continue to look at home or loans that we funded, our fix and flip loans. We're always looking at what the actual home sells for. And the loans that we're really concerned about are the loans that we funded in kind of the February, March, April timeframe, where you kind of peaked out on values. And we're still seeing homes selling on our properties in San Diego above what we underwrote them for. So I still feel very confident about the housing market for those very factors. Borrower uncertainty, I kind of tapped on that. Employment. What you've seen in San Diego, you've seen a lot of employees, and we've seen it in my community, a lot of people moving down from the Bay Area. People are moving, they're looking for a cheaper housing. I don't know how San Diego's cheaper housing, but it is to them. And so you saw a huge influx of people coming from the Bay Area. Apple has moved and bought right in this area a significant amount of commercial office space. So has Google, and so has Facebook as well. And so you've seen a lot of tech companies moving into the San Diego market. Headwinds for mortgage funds, bank credit lines. So we talked about how a lot of mortgage funds have credit lines to manage the liquidity in their fund. This is going to be problematic for mortgage funds that rely heavily on credit lines. Credit lines, the cost of that credit has gone up substantially. So mortgage funds have to increase what they're charging their borrowers. And in a lot of cases, banks are actually scaling back those credit lines. So they're, maybe they had a large $10 million credit line, they may be scaling that back to 7 or 5 million. Or it's even more difficult to even get an extension usually the credit lines are every year, just getting those extended for another year. And then the other thing that I want to talk about here, and this is what's really important when you just be cognizant of legislation. So here in the state of California, you have a legislation that is very pro-owner, okay, pro-renter. So during COVID, even 2008, they put a moratorium on doing foreclosures. I can promise you that if the market slows and you saw any increase in foreclosure activity, they're going to institute the same strategy. Now, we didn't have an issue with any foreclosures during COVID, but that's something that we take very seriously, which is why we're solely focused on doing non-owner occupied investment properties, which seems to be less affected when these moratoriums come in place. But it's really important to understand how that affects the ongoing servicing of your loan portfolio. Also, we've outsourced our loan servicing, and I'll talk a little about this in a minute. See how we do it on time. Okay. Is that you need to use a third-party loan servicing company. The rules are changing so quickly, and the states are really jumping on people that don't follow the rules. That for a mortgage fund like myself, as sophisticated as we are, we cannot follow all those rules. And so we use a third-party servicing company, and that's going to be a headwind for mortgage funds. Okay, so common questions for investors that want to invest in a mortgage fund. Do I need to be an accredited investor? In most cases, yes. We're a 501, we're called 501c regulated fund. That means that every investor that has to go into our fund has to be accredited. For those that are invested in our fund, I hear you. I know the frustration about going through the accreditation process. I promise you, though, I need to do it the right way. It's regulated by the federal government, by the SEC. They require this of me, and I hear you. I know it's frustrating. But in our case, you're an accredited investor. That's a 501c mortgage fund. Now, you can invest in a 501b mortgage fund. Big difference there is you don't have to be as accredited. When I say as accredited, in a C, you have to actually demonstrate with statements or from a letter from your CPA. In a 501b, you just sign a letter that you are accredited. There is some downsides, though. Technically, the fund manager can't outright market their fund. Has to be marketed to only close people. And then you can only have a certain number of accredited investors and non-accredited investors in the fund. I talked about how do I get accredited? The process is somewhat easy. Typically, you just get a letter from your CPA stating that you are I guess I forgot to tell you what an accredited investor is. Accredited investor is somebody who has a net worth $1 million exclusive of their personal residence, or have made as an individual $250,000, or as a couple, married couple, $300,000 in the last 2 years. So just effectively, you need $1 million net worth. But you have to be able to demonstrate that by either sending in a statement showing bank statement showing $1 million, or a brokerage statement, or you easily just get a letter from your CPA stating you're 1 million. Are you regulated by a state and or federal agency? I'm actually regulated by both. So I'm regulated by the state of California Department of Real Estate. I'm also regulated by the California CFPB. And then I'm also regulated by the SEC as well. So there's actually 3 agencies that I'm regulated by. What is my security in a mortgage fund? Security of your mortgage fund is you're a member of that LLC. So when you sign that subscription agreement, you now become a member of that LLC. The mortgage fund security is that deed of trust recorded on the property. How can I view the loans in the mortgage fund? Now, this is specific to TaliMar Financial. We do offer a lender portal. I'll go ahead and share a link to that lender portal. And so you can view all those mortgages in the fund. What happens in a foreclosure and our investors subject to litigation? We talked a little about this. What happens in a foreclosure is simply the mortgage fund will initiate the foreclosure versus what a trustee investor would do. And the litigation is limited to the mortgage fund. You as the investor are not exposed to that litigation. And then, can you add additional funds to your original investment? The answer is yes. So unlike a trustee investment where typically you have to wait for that investment to pay off, we have a minimum threshold of $50,000, and you can always add $1,000 above that thereafter. And again, we've waived the lockup period. Looks like another question came in. Thanks for the presentation. Okay, so how much skin in the game do you and your family have? So I have about so right now the fund is 23 million. I have 300,000 of my own capital in the fund. And actually, I'll probably be increasing that here over the next quarter as well. Okay, offering details. So we just talked about what a mortgage fund is. We talked about the pros and cons of investing in a mortgage fund. Good questions you should be asking your fund manager if you are invested in a fund. We talked about the headwinds that a mortgage fund will have here in the short and medium term. And then we talked about some of the common questions that I receive as a fund manager. So I'm going to go in and talk a little about our mortgage fund, TaliMar Income Fund 1. We are a 501c fund. Our offering size is 250 million, but we are an open fund, which means that money comes in and out. We're just capped at 250 million that we can raise. Our minimum investment in our fund is 50,000, and you can invest another 1,000 or more thereafter. When we originally established the fund, we had a preferred return structure. So that means that every investor would get a minimum amount, and then any proceeds after the investor received a minimum amount would be a 50-50 split. It became too complicated to explain every time to investors. So we just said, okay, investors are going to earn 100% of the proceeds coming out of the fund after TaliMar Financial earns a 1% loan servicing fee. So if the loan, if at a very basic level, if the weighted average coupon of the fund is 9.5, right? We take a 1% servicing spread, and the investor would earn 8.5 gross. That's before fund costs on their investment. So we earn 1% of the outstanding balance of that fund. We're in it with you. We don't get paid until that borrower makes a payment. So we want to ensure that the loans that we make are good loans. Distributions are made monthly. We do not have any management fee. The management fee is effectively that 1% servicing fee. Yes, you can reinvest. And we use leverage. So right now we have a $3 million line of credit with our bank, Endeavor Bank. We talked about that 90-day redemption rule. So we have up to 90 days to withdraw your funds. So over the last 5 withdrawals we did within the week. Our lending guidelines, we typically fund we only fund first position loans. The reason we put second position loans in there is if it makes financial sense to secure our first position loan to add additional funds to the loan for whatever reason, we want the option to be able to do that. But we're not going to be funding second position loans by themselves in the fund. Loan to value ratios, we're trying to stay below 70% loan to value. And loan terms are typically going to be 12. We have the option to go to 20 to 60 months, but with rates where they're going, we want to keep them as short term as possible. So you're really going to see like 12 to 18 months. And I'm catching up on time here, so I'm going to have to just push through these. Loan types we're doing are fix and flip loans and bridge loans. We did come out and we were going to consider new construction loans, but as I mentioned, that's not something that we're going to be focused on the short term. And the property types is going to be primarily focused on single family and multifamily properties. And again, small balance commercial loans. So if you looked at our loan portfolio, we're about weighted 80% single family, multifamily, I think 20% commercial. And then we're focused in the Western United States, but really at the end of the day, we're focused primarily in the San Diego marketplace, if not just Southern California. Let's see if this is going to let me go beyond 1 o'clock. It will. So I'm going to go over a little for those that need to leave. I appreciate you being on. And again, I'll go ahead and send out a recording of this video for those that need to leave. But we've got some more information that I want to share with you. For the fund, as I had mentioned, we really rely on third-party experts to manage certain functions of the fund. So TaliMar Financial originates all the loans. We go out, we market ourselves, and we bring in and underwrite the loans. But when it comes to various other aspects of the fund, for example, fund administration, so doing the physical monthly accounting, doing the statements and all that, we do not have that specialty in-house. We actually outsource that to a fund administrator, Verivest. They specialize in administrating. They do hundreds of mortgage funds. So they have the technology in place. And they also act as kind of a third-party reviewer of our accounting. Okay, so I don't do the accounting. It's all Verivest. Loan servicing. So loan servicing is the collections of payments from the borrower. Now, as I mentioned earlier, there's a lot of rules and regulations around loan servicing. Collecting payments the right way, notifying the borrower if the payment is late, going through that step-by-step process. At least the state of California has a very rigorous process that you have to follow. There's no way that I can know or my staff can know all those rules and regulations. So we've outsourced that to FCI. They physically collect the payment, they process the payment, and then they make that payment to the fund. So if you're a trusted investor that uses FCI, same way. Payments go to FCI and then they get distributed to you. Our legal is Gerasi. Gerasi is one of the biggest law firms that focus and manage mortgage funds. They've been a great partner for us. They continue to offer me education. I talked about being a certified fund manager. It's a great class to take, provide some really good insight on how to manage the day-to-day operations of a mortgage fund. And then our technology partner is BitCod. BitCod is the ones that developed our lender portal. So I'll talk about our fund overview right now. Our fund is 40 loans. We have roughly 23 million in total outstanding loans. Average loan size is 560, a little over 560,000. So good single hits on loan sizes here in the San Diego market. Average yield to the investor on this is 8.2%. Now, again, that's before fund costs. But right now, so the gross weighted average coupon in the fund is at 8.2%. As that fund grows, the costs become a smaller percentage of the total balance of the loan. So that the actual net yield to the investor becomes greater and greater. Right now, I think the net yield to the investor last month was 7.25% or 7.75% annualized. So average loan to value ratio of the fund right now is at 64%, and average term is 16 months. So I mentioned that we try to keep it as short as possible so that we are not at risk of interest rate risks, fluctuations in rate. So we try to keep those loans short term. I broke out kind of the loan types that we have in the portfolio and the property types. For those that added up, I know it's not going to add up to the numbers that I presented before, but we do have some loans that are for sale and loans that we have recently funded. So these are what right now, as we say, we have it in our stats. So loan type right now, about 54% are bridge loans. I consider bridge loans loans that there's no value add component to it. So borrowers not going in and rehabbing the property and selling it. These are just loans based upon current value, and the borrower intends to either just sell the property at a future date and or most likely they're going to refinance us out with conventional financing. Fix and flip and fix and hold are exactly what they say. Borrower intends to go in, they're purchasing the property, they're renovating it and selling it. It's probably one of the more common loans that we're known for in the San Diego market. And I think they're great loans simply because the borrower is adding value to the property. There's a clear exit. So the borrower intends to sell that property and the construction risk is relatively low. Most are simply doing cosmetic updates to the property. And then, as I mentioned, we've got one construction loan, but it's already on the market. Construction is done. And then once that's off, we won't have any construction loans. Property types, we're heavily weighted on SFRs. So that's 71% of that portfolio is SFRs. We've got 24% is commercial. So this is like small balance commercial loans. And then we have one industrial loan. What's interesting about the industrial loans is actually a very popular property type here in San Diego, and they've really held their values over the long term. Okay, location-wise, as I mentioned, we're heavy in the San Diego market. We've got over nearly 80% of our portfolio in San Diego. About the next is Tulare. We've got a client out there that purchases and manages a large portfolio of single-family rental properties. And then Los Angeles, Riverside, Santa Barbara, Fresno, and Imperial. I want to share for a minute the lender portal. For those that are not familiar or have not signed up for the lender portal, it is a great feature to have for investors. And the reason why is it provides you insight into the mortgage fund and it's up-to-date information. Let me go ahead and see if I can get out of this for a sec here and share the mortgage fund. So this is the lender portal. I can share the link to those who ask. I can go ahead and share that for you. And you can sign into the lender portal. And it's really the feature of this is for our investors to view all of their accounts. Okay. They can view their trust deed portfolio. So this breaks out all the trust deeds. It breaks out all our available trust deeds. So if you're only interested in investing in trust deeds, you can go here and view all the trust deeds that we currently have posted. You can, for example, on this loan, you could select learn more, and you can learn about buying into that trust deed. If you've got any questions about that, feel free to give me a call or my team, and I can more than happy to share with you the lender portal and all the details. And you can look at the mortgage fund in detail. So in this, If you were to select the mortgage fund drop-down menu, I can view all the invested dollars that we have in the mortgage fund. You can do a portfolio overview. So these are all the mortgage fund. This is all the stats that we just went over today. You can look at it by loan type. You can view the property types, the ownership type, and by state where we're exposed to. You can actually look at the loan schedule. So you can actually view down to the loan level, the location of the loan, property type, loan type, the ownership amount of each one of the loans, and then their loan status. So right now we've got all performing loans in the portfolio. If you're interested in getting the executive summary, you can select get executive summary. You can view and get access to the executive summary. And if you want to go ahead and subscribe, you can select add funds and subscribe directly here. So that's the power of the mortgage or the lender portal. You can essentially manage your investments with TaliMar Financial through the portal. And I'm going to finish with one last slide, just a little pitch for TaliMar Financial, my team. We've been in business for over 14 years. We've had a consistent track record of investor returns, and even better yet, return of investor capitals. We've never lost any investor capital. We've developed proprietary software that allows us to identify issues and provide transparency. That's really important. Again, we want to make sure that we're fully transparent with you, the investor, again, to keep that communication open, so you fully understand what you're investing in, to help fully understand how your portfolio is performing. And if you ever have any questions or concerns regarding the portfolio or your trustee, that you can always communicate those concerns with me or my team. We rely on third-party subject experts. So as I had mentioned, we have a fund administrator, we have a loan servicer, we have our legal team, we have our technology team. We rely on them because we know that we do not have the expertise in-house. We specialize in originating and underwriting loans, but when it comes to the physical other aspects of this portion of the business, we rely on our third-party experts. We focus on core property types. So we talked about single family, multifamily, small balance commercial. Stay away from riskier assets like land, construction loans, that type of stuff. In urban markets, you mentioned that we had a large percentage of our loans just in the San Diego area, and with strong borrowers. So we talked a little about earlier, really partnering or lending to borrowers that are experienced real estate investors. Those experienced real estate investors really want to work with mortgage funds. They want to work with direct lenders, which is why typically we're going to get a little better of a loan type to fund than maybe some of the other just solely trustee brokers. And then we focus on our education, accreditation, and verification. So we continue to educate ourselves on best practices, where the markets are going, accreditation. So I mentioned that I'm a certified fund manager, and we also obtained gold standard status with Verivest. It's really important to us that we have third parties really look look at us and tell us kind of what are the best practices in the industry. And then verification, just understanding that, hey, are we following the regulations required by both the state and federal government? And so it's important to us. So with that, I just want to say thank you. It's been a long time. This was actually ran over by about 10 minutes. So I really appreciate you sitting through and listening to me through this, through the webinar. There's a lot of information that I had to kind of gloss over, that if you're interested in learning more about the mortgage fund or have detailed questions about something, please feel free to give me a call. I've got my phone number right here. I've got my email address right there as well. Feel free to reach out to me, because there's a lot of information that I had to skip over, and then there's some questions that I know that some people may have. And if you're interested in getting a copy of this slideshow, feel free to just email me and I'll be more than happy to provide you a PDF copy of the slideshow. If you're interested in learning more about the mortgage fund, I'll go ahead and give you access to the fund. You can go to the website and simply go under investing, go to income fund, and go to about the TaliMar income fund right here. and you can request information on the fund there. If you're interested in getting access to the investor portal, just simply select investing and go to investor portal. And if you're ready to set up an account with us and either invest in the mortgage fund or invest in trust deeds, simply select new investor setup form, and you'll go through an online form to get set up onto our system, and my investment relations team will reach out to you to get you set up. And if you're ever interested in just looking at what available trust deeds we have, you can always select available trust deed investing and just go to available trust deeds. And in real time, we post all the available trust deeds that we have. So with that, again, I want to say thank you for listening. And feel free, again, if you got any questions ever about a trust deed or a mortgage fund or something, and you just want to bounce off ideas, I love chatting about this kind of stuff. So thanks again. Have a great day. Look forward to hearing from you.